These are the solutions to the practice quiz for week 5. So the first question, which of the following is not a reason? Oh, I hate these questions. The best way I think to answer them is to change the question from which of the following is a reason that actual results may deviate from planned performance, and then see what's left over. So is it a reason, let's start at the bottom, is it a reason that, if the budget was poorly conceived and constructed, then that would explain why things are different? If it was the case that conditions have changed since the budget was originally developed, then again, that would explain why actual results deviate from what was planned. If If it were the case that managers have done a particularly good job or a particularly bad job of managing operations, again, that would be an explanation as to why the actual results deviate from the planned performance. And then, if it were the case that a bottom-up approach to budgeting was used, well, that shouldn't explain it. It should be more the other way around, that if a top-down approach was used, that would be a valid reason. And so in this case, what we've got is a bottom reason is the only factor here that's not a reason why actual results deviate from planned. Ace Ladders has fewer units in beginning finished goods ending inventory than in ending finished goods inventory. Probably easier, I think, to see this other way around, that ending finished goods units and in ending finished goods inventory has more, so inventory is over time increasing. And so if we start off with January the 1st, say a balance of 1,000 units, and we end the year with 1231, let's say 1,100 units, we know this is going to go up with purchases, and it, let's say X, and it goes down with sales. So it must be that in this case the number of units sold is less than the number of units purchased. So the number of units sold is less than the number of units purchased. That's the only right answer. Question 3. Salarita's sales are partly on cash and partly on credit, and then the credit sales come in over a number of months, and we have the budgeted sales data given, and so how much is the total cash collected? Presumably what they really mean. The only sensible way to interpret the question is, what is the budgeted cash to be in budgeted cash collection during August? And so if you think about it, well, we've got cash sales from each of the months. We've got credit sales from each of the months. Let's say credit sales. And if we're looking at the in August collection, well, we'll have 150,000 sales in cash, of which 32% were in cash. So 150,000 at 32% gives us 48,000. And then the credit sales, well, the credit sales from June, where it was 200,000, and so 200,000 of which 68% was on credit, and of those credit sales we know that the month following, 15% is 2 months later, so 15% of this June sales are coming in August, so that gives us 20,400. Of the July sales, we've got 120,000 in total, so 68% was on credit, and of those sales 45% came in a month later, so that's 36,720. And then of the sales in August, 150,000, of which 68% was credit sales, and the credit sales that were collected in the month were 40%. So 40% of 68% of 150,000 is 40,800. And so if we add this with this, we get the total cash collections, and it comes to 145,920. So the answer is A. The next question. When budgets are used for evaluation, what's the difference between the budgeted and the actual amounts called? Or various things, but is it any of these? Well, it's certainly not flexible budgets, so it's not that. It's not the performance results. Is exceptions? It's sort of exceptional, but it's certainly not as good a definition as budget variances. There are various things which could be exceptions, and so no, the answer is B, budget variances. Question 5. Umazy Inc.'s budgeted income statement for the year is as follows. Sales 80,000 units, some various things, direct materials, direct labour, variable overhead, which will take as variable costs, fixed overheads, fixed selling and admin obviously will take as fixed costs, and how much income before taxes would appear on a flexible budget or a flexed budget for 84,000 units. So clearly we're going to say we're going to scale things up. We'll scale up the variable costs. So this is based on 80,000 units. And if we base it on 84,000 units, then the variable costs and revenues will go up proportionately by an extra 5%. So we'd have 360,000 multiplied by 84/80ths, which is 378,000. We've got the total variable costs in an 80,000 unit budget, which is, what's this, 128 plus 68 is 196,000. So 196,000 multiplied by 84/80ths gives us 205,800. Hopefully a cost will come off. And then the fixed costs, fixed overheads and fixed selling and admin is a total of 22,000. And of course the whole point about calling them fixed is that we're saying they don't change within the relevant range, and for a change in output of 5% is not a big deal, so we can reasonably assume that the fixed costs will be the same at 84,000 as they were at 80,000, so they'll still be 22,000, and hence income before taxes is 378 less 205,800 less 22,000, and that comes to 150,200. So the answer is another A. Question 6. Workman Company had sales of 15,000 units of its only product in the first quarter of the year. In the first quarter of the next year, Workman anticipates selling 20% more units than it sold in the first quarter of this year, with a selling price of $68 per unit. What's the amount of sales revenue that will appear in the budgeted income statement for the first quarter of 2018? Well, we can say it's the sales units will have gone up by, we're told, 20%. So it was sales of 15,000 and it's going to increase by 20%. So I'd say 15,000 multiplied by 120% will give us 18,000 units. And then the unit selling price is anticipated to be $68 per unit, so 18,000 multiplied by $68 gives us budgeted sales revenue of 1,224,000. So the answer is, yet again, an A. I wouldn't rely on them being A's in the real quiz, but who knows. Question 7. This is perhaps one of the trickiest questions, or involved questions, on the practice quiz. We're told that Bake Time makes and sells baking pans. Each pan uses 0.7 pounds of aluminum. Budgeted production and sales of pans is given over the next 5 months. We can see it goes up, it goes down. We're told that the company wants to maintain monthly ending inventories of aluminum equal to 15% of the following month's production needs, and monthly inventories of pans, that is finished goods, equal to 20% of the number needed for next month's sales. And so presumably it's producing in the month 80% of the current month's sales, and then 20% of the current month's sales was produced in the previous month. And the cost of aluminum, something, how much is the budgeted cost of materials for August. Now in fact we don't actually need to do this, but we could say, just to check up, because we can say that, okay, so if the sales are going to be, we can see 26,700, so the production in August is going to be 20% of the next month's sales, and that's going to be 5,340. And then in addition, the production in August is also going to be 80% of the August sales, so that's 24,500 multiplied by 80%. So 24,500 times 80% is 19,600. And that's where the production for the month of 24,940 comes from. And so if this had been a really complicated question, they could have not given you the budgeted production. They could have just said, here's the budgeted sales, and this gives us then the production in August. And of course we could do similarly what we would need for production in September, and hence we could get to the production, the sales in, the production in September, which would depend on sales in September and October, and hence we could get to the budgeted production figure in August. But in fact we don't, the raw material supplies in August, but we don't need to. We can just rely on the numbers given for the production level in the next 2 months. And so in this case we know that we're told that they need 15% of the following month's budget production needs, and therefore 85% within the month. And so if this is in units, this is budgeted productions, this is in units. And so if we look at the budgeted production in pounds of aluminum, then the amount of aluminum that's going to be used up in August is 24,940 multiplied by 0.7, which is 17,458. 17,458. And the amount of aluminum that's going to be used up in September is 26,240 pans multiplied by 0.7 pounds of aluminum per pan, which is 18,368. And so the purchasers in August will be, well, of that 17,458 pounds of aluminum used in the month of August, 15% will have been purchased in July, and so the purchases in August will be 85% of the 17,458 pounds, 458 pounds of aluminum. And there'll also be purchases of 15% of the aluminum that's going to be used up in September, which is 15% of 18,368. So we have 18,368 multiplied by 0.15 is 2755.2 as it happens. And then 17,458 pounds of aluminum multiplied by 0.85 is 14,839.3. And so the total volume or total mass of aluminum purchased is 14,839.3 plus 2755.2, which is 17,594.5. 17,594.5, and the cost of the aluminum is 85 cents per pound, which is, so multiplied by 0.85, gives us total purchases of 14,955.3. So 14,955.3. Hope that's an answer. 1495. Okay, that's the closest to C. Pretty good. And the next question. Question 8. So the difference between standard costs and actual cost is, well, that's what we call the standard cost. Yeah, I mean, the obvious standard is just a standard cost variance. Is considered to be an ideal standard. Well, no, it's not. In fact, not necessarily an ideal standard would be one where you did get zero cost. There's various ways of measuring ideals. Is it a variance by exception? Well, no, it's nothing to do with that. Is it a... No, I mean, the other answers are nonsense. Question 9. Which of the following is true concerning standard and budgeted costs? So is it true that standard cost multiplied by expected production levels equals the budgeted cost? Standard cost multiplied by the expected production level. Sort of, but I suspect there might be a better answer, so let's carry on. Because this would be what we put in the original budget, but maybe there's one that they want us on the flex budget. Standard cost multiplied by the predetermined overhead rate equals the budgeted cost. Standard cost multiplied by the predetermined overhead rate. Well, that certainly sounds plausible. Is it the case that total budgeted cost divided by actual units? Well, no, because it would be total budgeted cost divided by budgeted units, so that's definitely wrong. And none of the answers, well, it's not that. So the question is it the case that B is a better answer than A? I think it is, because standard cost, I think what they're saying here, that they're looking at total budgeted cost. So if this is total budgeted cost, we're not using this to be total standard cost. This is standard cost multiplied by the expected production equals, I mean, this would have to say total budgeted cost to be true. So the only real answer is B. Question 10. Scotto Design has the following standards for the production of scarves: different standard quantities, standard prices, direct materials, direct labour, and we're looking at the direct materials quantity variance. And if you recall, we're going to measure the quantity variance by saying, well, what was the quantity that was used, what was the quantity that they should have used given the level of production. And so the company made 800 scarves, and so the quantity that they should have used, so quantity, if you like, should have been, based on the budget, they would have said, well, 800 yards at how much? And the quantity was 1.2 yards per scarf. So 800 multiplied by 1 point, and again this is scarves if we do dimensional analysis, so 1.2 yards per scarf. So we can see that scarves multiplied by yards per scarf is going to give us an answer in yards. It's 960 yards. The actual quantity used was 985 yards, and so the variance in terms of quantity, the quantity variance in terms of units of material, was 985 they used, and it should have been 960, so there's an excess of 25 yards. And then to put that in dollar terms, we say 25 multiplied by, and we'll use the standard price per yard at $4.70, and 25 yards at $4.70 gives us $117.50. And obviously this is bad news. Again, this is dollars per yard, so this is yards. Again, 25 yards multiplied by dollars per yard gives us dollars, so $117.50. I guess they want us to round it to $118. Unfavourable. Question 11. Blue Box Beach Chairs has the following standards. Give us standard quantities, standard prices, materials and labour. The static budget was based on production of 6,200 beach chairs. The company used certain pounds of polywood in order to make some chairs. It purchased pounds of polywood, a total cost of this. It's used some labour hour, and they want to know what is the direct labour efficiency, if you like, direct labour usage variance. So again, this is like the quantity variance that we just computed for materials. So we'd say the expected labour usage based on the output, so expected labour usage is based on the output multiplied by the standard quantity of labour. So we'd say the output was 6,000, right? The static budget was based on 6,200, but we know we're going to ignore that now. What we care about is the actual output. So to make 6,000 chairs, we would have expected them to use 6,000, again, let's say this is chairs, multiplied by, and the standard usage is 0.65 hours per chair. So 0.65 hours per chair. So chairs multiplied by hours per chair gives us hours of 3,900 hours. The actual hours was 3840, so we already know that's less than the budget, so it must be a favourable effect because they saved 60 hours. And so we can say that the efficiency variance is this 60 hours saving, and we multiply that by the standard cost of labour, which is $13 per hour. So 60 hours at $30 per hour gives us a saving in dollar terms of $780. Favourable. And so answer C. Question 12. For which of the following reasons does the volume variance arise? Well, remember, the volume variance arises when the production is less than the volume, or was different from the volume that was anticipated. So overhead costs are incurred at a greater or less than amount budgeted. No, it's clearly not that, because we just said it's to do with volume. B, the company operated at a more or less units of production. Well, that certainly sounds likely, so let's hope that the other two are wrong. Actual activity equaled the volume. Well, no, we just said it was when it's a difference in volume. And the company purchase has nothing to do with purchasing raw materials, and so there clearly only is one answer, and it is B. Question 13. Which of the following is not a criterion that a company might use to determine whether or not a variance is exceptional? Again, these which is not. Let's look at which ones are. So which of the following is, what might we do to identify that a company, what's a criteria that a company might use to determine whether or not a variance is exceptional? So is the variance based on a significant percentage of the standard cost? Yeah, I mean, that would be reasonable. If it's a big percentage, we'd care about it. Is it the case that the variance is unfavourable? You wouldn't say it would be or it wouldn't be, so that looks as if that's going to be the answer. Is it the case that the variances are for a large dollar amount? Well, again, yes. If the variance is for a large dollar amount, then that would be a criteria that a company might use to determine whether or not it's exceptional, whether it's worth investigating. Is it for the variances a significant percentage of the flexible budget amount? Again, so yes, it would be a good reason to look into it. So, yep, the fact that it's unfavourable is not, and so the answer is which of the following is not a criterion, just that the variance is unfavourable. Question 14. Ultimate Production manufactures radon detectors. The standard for materials for each detector is £2 of acrylic at a standard cost of $4.30 per pound. And let's go to the question mark. How much is the material price variance? And so we know the material price variance is going to be the difference between what they paid for what they bought and what they expected to pay for what they bought. And we can see here that the company purchased £890. It used a different number and it made them. We don't care about that. What we care about is what was purchased. And so the actual cost of materials, and this time they give us in per pound, so we need to multiply through. Sometimes they won't. So the actual cost of materials is 890 at $4.45 per pound. So 890 at $4.45 is $39.60 and 50 cents. And the standard cost of buying those materials, in other words the expected cost, normally the expected, but maybe not, because sometimes standards are built with a bit of slack built in, or if you know that prices are going to change during the year, you might expect to incur favourable variances at one time of the year and unfavourable at other times of the year. But the standard cost of these materials is, well, 890, and they're saying, yeah, we expected it to cost, where is it, £2 of material at $4.30 per pound. So they were anticipating paying $4.30, they paid $4.45. And of course you could also say, oh well, there's a difference in the purchase price of 15, and so again you could just say 890 at 15 cents would also get there. 890 at 430 is 38.27. 38.27. And so there's this difference of $133.50, and clearly that's unfavourable because the actual price was bigger than the anticipated price. So 133.50 unfavourable. Well, the closest we've got is 134. And then finally, question 15. Glue for All has developed the following material standard to produce one container of Glue-It. And again, let's look for the question mark. What is the material quantity variance? And we know that's going to depend on the expected quantity that should have been used and the actual quantity that was used. So the expected quantity will depend on the level of output. So expected quantity to be used was based on the output, and they produced 1950 containers. So they would have expected to use 1950 multiplied by, and we're told it's 96 ounces of the material. So 1950 multiplied by 96 is 187,200, and they actually used 1,480 gallons, and so we do need to do this conversion, which is how many ounces in a gallon, and 192,000 divided by 1,500 is 128 gallons. So 128 ounces per gallon. And so the company used 1,480 gallons, so the actual quantity is 1,480 gallons multiplied by 128 ounces per gallon, which we said is 1480 multiplied by 128, which is 199,440 ounces, and so the difference less 187,200 is 2,240 ounces. And so the effect of that, we know that the cost, standard cost, is 14 cents per, sorry, that's the actual cost. The budgeted cost was 15 cents per ounce, and so the usage variance at the standard price of 15 cents per ounce is 2240 multiplied by 0.15, which is $336. And again, we can see that the actual quantity is bigger than the standard quantity, so this is an unfavourable variance. So the answer is C.